Hello, YouTube. Hello, Twitter. How's everybody doing? Let me get my camera adjusted here. Happy Thanksgiving. Happy Turkey Day. Hope it's been a good one for you guys. Come here, Jackson. Come here. Come here. There you go, buddy. Such a good doggy. This doggy is so good. He is a good dog. All right, guys. Well, yeah, happy Turkey Day from Jackson and myself. All right, Jackson, go lay down now. Go behave. All right. Hope you guys had a good Turkey Day. I had the usual stuff. I haven't watched any football yet. Football, usually this is a great day for football, but I've been busy making content all day. Darn it. The Cowboys played today, and Dak Prescott is the starting quarterback on my fantasy team. I wonder how they did. I wonder how Dak's did. I also have CeeDee Lamb, so I'm pretty heavily levered to the Cowboys. Yeah, I'm doing pretty well. Dak Prescott had 32 points, and CeeDee Lamb had 27. Heck yes. I also have Xavier Worthy from the University of Texas. He plays at Kansas City now. He had 7 points. And I have Cameron Dicker, the kicker from the University of Texas also. Anyway, I like my team this year. All right, guys. I have some Texans and some Oklahomans. That's what it's all about. All right. Even though Oklahomans are probably from Texas, I mean, half of OU's football team, or I'd say 90% of Oklahoma's football team is Texans. All right, guys, let's tonight we're going to do the daily factor, and it's going to be dealer's choice. But since the market's been closed for a day, let's check the market really quick. I was just looking at Bitcoin earlier. Look, Bitcoin's vastly improved, but it kind of made a little double or triple top here at 91. I mean, but even if it goes down, which it is, hopefully it'll make a higher low. 88, this looks like a good place to buy the dip. 89.5 and then maybe even 88 for dip buyers. Then hopefully the bulls will gather steam and then eventually take it up here and convert to mean back up here at 95. That would be awesome. It's a step in the right direction. We still have a long way to go. All right, let's see how the stock index futures are going. Look at this, Russell. Look at this. Heck yes. Heck yeah. Oh, that's okay. That's Friday's close. That's not 24-hour trading. That's the Russell. But this is Russell futures. That looks really good. Russell futures have already reverted to the mean. They've got way ahead of their skis on the low side. Reverted to the mean and then some. I like to see that. Let's look at S&P futures. S&P futures aren't as strong as Russell futures. S&P futures have not yet reverted to their mean. Their mean's up here at 68.75, but they're trying to take back this darn trend line. Come on, look at that. Heck yes. Heck yes. At some point, the buyers or sellers will come back in. 68.18 looks like a dip buy to me, and 67.90, something like that, could be a good dip buy. Now let's check out the old NASDAQ. Let's check out the old NASDAQ. Where's the old NASDAQ? Well, there it is. Heck yes. Heck yes. All right. Well, they've already reverted to their mean on this chart. Their mean was 25,150. They've got a little bit over their mean, but they have another big point of control, another trading range up here centered at 25,640. That'd be next stop for the bulls. If you're a bear, dip buy might happen or if you're a bull and want to buy the dip, 25,163 maybe, or in a bigger pullback, 24,980 or even 24,935, something like that. All right. So then all that matters is the Bitcoin's going up. I mean, I'm just joking, but that's a big part of what matters. All right. Hey, Bond, how are you doing there? Bond's in the house. Bon is in the house. Oh, you're listening to my video right now. Well, good. I hope you appreciate. I hope you like it. I don't care if you appreciate it. It'd be great. I mean, I want you know what I'm saying. I hope you like it. I worked hard on it. I even made slides and wrote a script, but I'm just not good at reading from a script. I like to just talk like I do in this show. And I feel that's kind of my strength. Doing scripted content is not my strength, but I'll practice on it. I'll try to get better. But anyway, thank you so much for watching that. And I can answer any questions about that, or we can talk about that after we get done with the daily factor. So let me switch my style back here to minimum. I like that minimum better. And also, this is a good time to remind everybody, this isn't financial advice. Nothing you see here is check everything you hear on social media, especially, but anywhere with a licensed financial planner who has your best interest at heart. All right, so let's look. Let's see what is going on. You put it on hold to listen live to this. Okay, well, very good, Bon. Thank you so much. Just got back from dinner. Do you guys do a late dinner? We usually do 2 or 3. My family eats at 2 or 3, but some families eat at 6 or 7, have an actual Thanksgiving dinner. In the South, we call it Thanksgiving supper. Supper in the South means basically lunch, especially in the deep South. They always say, I'm going to supper, and it means going to lunch. So anyway, all right. Well, I hear you, and I'm not. That video wasn't. We'll talk about that later. We can talk about all this stuff later. Let's get in the middle of what we came here for. Let's look at this max factor. And I have a good one planned out for you tonight. If I can ever find the darn page. Where is it? There it is. Okay. Tonight is Editor's Choice Thursday night. And what I did is I put some of my favorite funds on here. And I didn't choose Alti or K. I didn't choose any of the super volatile ones. But I just chose some ones that kind of medium volatility that, pay a decent yield. And I didn't choose any that are broad-based. I didn't put anything that has the whole Qs or the whole SPY in there. We do those on Saturday night. But I chose ones that are portfolios, ones that have anywhere between 5, 10, 15, 20, 25, 30 stocks, things like FEPI and SEPI and YMAG and YMAX and just things like that. I should have put WPay in here. I forgot to put Well, anyway, whatever. WPay is not in here, but it's Editor's Choice. I don't know how I missed getting WPay in here. It would have been perfect, but whatever. So it's Editor's Choice. So what I've done is I've lined up 22 ETFs. So let's introduce the contestants. So we always start with highest yield. Now, remember, the daily factor is my own proprietary metric. I don't think that, my opinion, total return really doesn't describe these or measure these high yield ETFs well enough. It's better than looking at yield. Yield is the worst way to look at these high yield ETFs. But I think there's a better metric also. No two total returns are created the same. Anyway, I'm trying to look at an apples to apples comparison and look at the elements to make up total return. Total return's made up by NAV return and by dividend, but I'm more interested in how they interact with each other. You don't want such a high NAV or you don't want such a high dividend that kills your NAV return. So you don't just want such a high NAV return, you have no dividend either. I mean, if you wanted to do that, you could just get the SPY or the Qs, right? So anyway, and also we want to consider risk. If you have, let's say you have 2 funds that have a total return of 20%. Okay. So are they equal? Yeah, maybe. But I mean, let's say fund number A was up 90% and then down 90% and it finished the year plus 20%. Okay. But let's say fund B was maybe up 30% and down, down to 10% and then finished 20. So in other words, it's way less volatile. Well, B is a lot more valuable to allocate in a portfolio because A could have got you a margin call. I mean, there's all kinds of problems. You don't want to have excessive volatility when you don't have to. So that's the theory behind the daily factor. But remember, or behind the max factor, remember the max factor is just looking back at these funds in a slice of time. And it's also kind of a trading index. It has kind of a short look back period. We only look back about a quarter because I'm also trying to catch the elements of momentum. Okay, anyway, so we'll start with the highest yield. We have YMAX. I mean, YMAX is a monster. yielding 78%. Now, that's the good news. The bad news is that NAV's down 17% for this quarter. So, that's usually the way it works. The higher the yield, the worse the NAV is. So it's not a total surprise, but it is something to be aware of. Contestant number 2 is YMAG. Now, YMAG is the MAG 7, and this one pays 53.4. Price 90 days ago was 15.25. The price Friday or Wednesday was 14.55. So it's down about 90 cents in the past 90 days. I mean, that's really not too bad considering that the market's just really got beaten up, especially in the past, 2 or 3. And November's been lousy for the market. Maybe outside of the last couple of days, but before the last couple of days, November's been a bust. In any event. All right, next we have SEPI yielding 46%. Now, SEPI's NAV is down about $4 or $5. That's down 11%. They didn't do near as well as YMAG did as far as protecting NAV, and they made a little bit less of a dividend. I definitely prefer YMAG just among these, but just, choosing between these two. To be fair, SEPI is crypto stocks, and crypto has particularly been beaten up. In fact, Bitcoin is in a bear market. And even though the SPY and the Qs are pulling back, they're nowhere close to a bear market. They've had a bad November, but they nowhere close to a bear market. Anyway, so we do have to consider that with SEPI. SEPI's not a bad. It's not a bad ETF, but its underlines are not hot right now. They're the opposite of hot. In any event, all right, 5E is interesting. This one only has 5 ETFs, and they rotate their ETFs in and out based on technical analysis. And actually, I didn't like 5E, and I thought that their system for rotating ETFs in and out reacted too slowly, and that's why I built the Max Factor. I built the Max Factor so I could choose ETFs for my own portfolio, but I wanted to be a little bit more active and be able to catch momentum. 5E to me just hasn't lived up to what I had hoped for it anyway. But in any event, it went from 38 to 32. So I mean, it's off 16%. That's pretty ugly. I mean, it does pay a 42% yield, but I mean, part of the reason that yield's high is because the NAV's under pressure, but the Max Factor doesn't get fooled by that. Total return does get fooled by that, but the Max Factor does not. All right, AIPI. Now, AIPI is, let's look at this. It pays 38%. I really don't study this one that much. I mean, to be fair, though, look at this. The NAV is down from 40, call it 42 to 41 to 40 and a half. It's not too bad. Really not too bad at all. Okay, and then we have GPTY. This thing's a monster. I mean, it pays a 35% yield. The NAV's down 2%. I trade 2% for 35 every day of the week. I mean, if you could do that every day of the week, you could compound. I mean, that'd be awesome, but you can't. But anyway, AIPI and GPTY have similar stocks in them. GPTY is AI related, and so is AIPI. They have AI stocks, and AI stocks have been good. All right, now we have Maggie from Round Hill. Now, this is a good one. Nothing wrong with this one. Pays a 33% yield. NAV's down about 5% this quarter, but I trade 5 for 33 all day long. There's nothing wrong with this one. Next, we have Eggy. Eggy's, I just put it in here because I kind of put in ones that we don't really talk about much other times. But anyway, Eggy pays 27%. NAV's off about 6%. I mean, I guess that's all right. Now, FEPI, I like FEPI. I don't have any, but FEPI's a good one. I wouldn't have any problem with getting it. I just own ones that I think are better, like GPTY. But in any event, FEPI's a good one. So the NAV went from 45 to 45, basically. It lost 60 cents. I mean, that's 1.4. Now, the dividend isn't as high as GPTY's. In fact, it's about a third. It's about 33% less, but they do have a little bit better NAV return. So, of course, that would make sense. Dividends a tax on NAV return. So, all right, GIAX. Now, this one I'm making a video about right now. This one, they've changed their strategy. I think this one has a lot of potential, especially going forwards. I realize that lately folks have been disappointed with it a little bit. Hopefully the strategy change will work. But it's paying 22% and the NAV's down like 30, 40 cents in 90 days. I've seen worse ETFs, or I've seen worse metrics or whatever. Yield's a little low for my taste, but you get some NAV stability. All right, then we have SPI-T. I like this one. It's a target 20 fund, and it's doing what it's supposed to, paying 20. Has partially uncapped upside. They sell covered call spreads. They were the second ETF to do trying to think, or they were the first ETF I know of to go to full-time covered call spreads and uncap part of the upside. Then after they did that, the entire YieldMax suite followed, and all of the YieldMax single stocks now have partially uncapped upside and have been a lot better for it. This thing, it does pretty well on NAV. NAV dropped, what is that, 36 cents or something, 35 cents? I'm not very good at math, 35 cents and a quarter. That's pretty dang good. If 20% is enough yield for you, it is. All right. So then we have SFOL. We never hardly talk about this. I just threw in ones tonight that we don't talk about that much. It's paying 19.96. It has flat NAV. It's not bad. Then we have Omaha. Omaha is also a basket of like 15 or 20 stocks. So I figured it would go well into some of these comparisons. A lot of these are based on 15 or 20 stocks. I realize SPI-T isn't. It's based on the entire index, but I brought it in here more because it has a little bit, because it's a target 20 fund. A lot of these are paying around 20%. I thought it'd be a good comparison with SFOL and with FEPI and EGGI and stuff like that. So anyway, Omaha should be a good one also. Now look at Omaha. Now, unfortunately, it only pays 15.7%, and its NAV is not doing as well as some of the other ones that pay higher and have better NAV return. But whatever, can't have everything. Eggs pays 14%. NAV is actually down about 3%. XV, I put it in here because it's one we don't talk about enough. It pays 15, 20%. NAV's pretty dang stable. What's the NAV done? Dropped, 16 cents? That's not bad. 16 cents in 90 days, and it's paying a 14.07% yield at this rate. Then we have Will. Will is also based on a smaller basket of stocks. I figured it'd be a good comparison in here. It is, the NAV here has dropped, 3 cents, but it's paid a $2.53 dividend. Well, that's on a trailing 12-month basis. But anyway, it's still doing pretty well. Then SBAR is one we don't talk about enough. It's a barrier fund, so it pays a little bit less yield, but I thought it'd be a good comparison in here. Barrier funds take less risk, and therefore we would expect less reward with less risk. XV and SBAR are both barrier funds. SBAR has a bigger barrier than XV does. And so sure enough, SBAR pays a little bit less yield because you take less risk with SBAR than you do with XV. So, it makes sense to me. Big Y's a monster. This thing, it only pays 10.3%. It's supposed to pay 12, but look, the NAV of this thing went from 51.63 to 53.35. This thing beats a lot of other ETFs that people, really like. So, a lot of people sleep on this one for sure. But probably because it doesn't pay a high yield. Out of the YieldMax ones, my favorite is GPTY. I think GPTY, but anyway, whatever. Soxy, kind of the same thing. A lot of people sleep on this. It pays a small yield. It's a target 12 fund, but the NAV's gone from 53 to 58. Are you serious? NAV's up 10%. Unfortunately, it only pays a 9% yield, but it's a pretty good combination. If it keeps up that pace, that'd be a pretty nice year. You get because it'll pay 12 by the end of the year. It's a 12% target fund. It should anyway. You collect your 12%, and if you can make 9% every quarter in NAV, my Lord, 36%. That'd be like a 46% total return. You could double your money every year if it keeps having years like every 2 years. or less than every 2 years if it keeps having years like this. All right. EGGQ. All right. Another one we don't talk about enough, just pays 5%, but because it pays smaller amount, it does better on NAV. We totally expect that. In fact, look at this. It's red up here where the higher amounts are, green down here. It's just math. It's just math. It's that's the main thing that these funds, the main thing you have to know, like I always say, is how much is the yield and what is the underlying. Those are the main things. The option strategies and the management and whatever, that stuff matters too, but not nearly as much as how much is the yield and what's the underlying. All right. IDEVO. Now, I put this one in because you guys like it. 5.36. It's a popular one. Look at all that NAV, though. Look at that positive 6% on NAV. That's not nearly as good as Biggie, or I'm sorry, not Biggie, Soxy. Soxy that has better NAV and better yield, but whatever. Or it hasn't been as good this quarter. But a lot of stuff hasn't been as good as Soxy. That's not a really fair comparison. And then Devo. Devo pays even a little bit less, but I mean, it has really good NAV return. So hopefully I got some of your favorite ones in there. Hey, Kay, how are you doing? I appreciate it. Rec shares for what it's worth, or FTW. I don't get that. Anyway, whatever. Hey, thank you for watching the Alti video and commenting on it, Brad. I appreciate that. I tried to make a serious video. The last Alti video I made was a little bit trolly or whatever, or it was more fun. I make fun videos sometimes where I have hot takes, but today I was trying to make a serious video with slides and a script, but I'm just not a natural at reading the script. I don't know why. I do so much better when I'm just, speaking off the top of my head. Okay, so hopefully we have some things in here. Yes, I have heard that GX is going weekly, and I'm working on a review on that now. And I'm going to show you why it's going to be a better fund, in my opinion. I mean, better on the way up, worse on the way down. But anyway, we'll get to that later. I can answer more questions about that. All right, let's get back in the middle of this. So we've met our contestants. So let's talk the stable DEX. This is important. Now, I really like this metric. I designed this metric specifically for these high yield funds, and this metric is one of the inputs in the max factor. There's 3 inputs in the max factor, and this is one of them. But so it matters a lot. So what the stable DEX is it indexes. It's an index where it measures a fund's stability relative to the SPY. So if you have a fund, which is the craziest fund in the world, like MST from there's always a good example, just absolutely the craziest fund out there. It's from Defiance, and it's double leveraged strategy, and they sell premium, and they pay like a giant yield. So it has multiple strikes against it. It has leverage, and it sells a lot of premium, so it pays a giant yield. And you guys know what yield is. It's a tax on the future upside. So that one's a hot mess. Well, that one, as far as on the stability index, it's a 0.12. Okay. The SPY, it's indexed to 1. So if something's a 0.12, that means it's 1/8, because 12 goes into 108 times, right? Yeah, something like that. 8.3 actually, but it's 8 times as crazy as the SPY. Meaning, if the SPY's up 1% on average, that one could easily be up 8%. And same thing on the way down. It's just absolutely insane. Well, anyway, most aren't that crazy. So something like WiMAX that's a 50 on the stable DEX, well, that means it's half as stable. It's half as stable as the SPY. So, and we'd expect that because it's concentrated. I mean, WiMAX has a lot of Bitcoin and tech stocks and high flyers, whatever. Now, YMAG, on the other hand, is comprised of the 7 biggest. It's comprised of the MAG 7. Are they the 7 biggest stocks also? I mean, I guess they are. Anyway, so those are more blue chippy, and it's a 63, meaning it's 63% as stable as a SPY. And I would expect that because it has things like Google in it that are pretty stable. Anyway, SEPI. Now, SEPI's based on crypto industry. So, I mean, it's about a third as stable as the SPY, but that's fine. It pays a giant yield. You get the big yield, I mean, that's fine. Now, 5E. Now, 5E is not very stable at all. It's only a third as stable as the SPY. AIPI is based on the AI industry, and it's pretty darn stable. AIPI is actually about as stable as YMAG. So that's interesting. Now, GPTY is only half as stable as the broader market. They have they have AI exposure in that one also, but you can just tell by looking at the stable DEX, the GPTY takes more chances. They have more volatile underlines, or more volatile stocks in their portfolio, because AIPI is is more stable. So that's a good look for AIPI right there. And AIPI from Rex all of the Rex ones are really nice funds. I mean, I like most of these funds. I chose the ones kind of that I like. I mean, I'm just in love with YMAG. I mean, YMAG's all right. YMAG, GPTY, Biggie, but also FEPI's a good one. There's several good ones in here. SBAR, XV. So anyway, that's why it's editor's choice tonight. Anyway, GPTY, okay, not too stable. Now, Maggie, on the other hand, this thing is super stable. It's 83% as stable as the SPY. That's pretty darn stable. Anyway, EGGY, this is from our friends at Nestiel. This one's a little bit less than half as stable as the SPY. FEPI's 60% as stable as the SPY. That's good. I mean, that's really good. GX from from X Funds is a 65 on the stable DEX. Now SPY-T is based on the entire index, and they sell options, but they sell options in a way that doesn't add a lot of risk to the equation. So they're just pretty much darn near stable as the SPY. Anyway, SVOL, look at SVOL. SVOL is the first one that's actually more stable than the SPY. Believe it or not, it didn't used to be that way. And I kind of have a hard time believing it is, but the stable DEX is only based on the past 90 days. So if you're thinking about the SVOL from last year, it's a different SVOL than it's been lately. So in any event, Omaha, now look at Omaha. This one has a lot of Warren Buffett type stocks with earnings, stocks with price, with earnings growth and reason, growth at a reasonable price, and all the good things that allocators like. Now they sell covered calls on them, but still they choose the kind of steady Eddie stocks. So this one's actually 20% more stable than the market. So this one could be good for people not wanting to take as much risk, and you get a 15% yield. That's pretty good when you have more stability than the market plus a 15% yield. That one's hard to beat. That one may be the editor's choice tonight. I don't know. Anyway, then we have EGGS. EGGS is a 60 on stability. Okay. XV. Now, this is the barrier fund. This thing's really nice. I mean, these barrier funds are pretty dang stable, and this one's 20% more stable than the market. And I mean, that's good. And it pays a 14% yield. I mean, that one could be editor's choice. Will is a good looking one too. Will, they do the will strategy on individual stocks that they choose to do it on, and the stocks they do it on must be pretty dang safe because they're safer than the SPY as far as the up and down movements. This doesn't measure how good a fund is. A fund can be super stable and still be a huge underperformer, or it can be super unstable and be a huge outperformer. It depends on more than that, but this measures how seasick you'll get having it, or how likely you'll be to get a margin call, let's say, or whatever. All right, then we have SBAR. Now SBAR is even more stable than XV, and that makes sense because SBAR uses a bigger barrier, meaning that SBAR takes less risk. It also pays a little less yield, but of course, with risk goes reward. With reward goes risk. So it's less risk and less reward, just like we'd expect. Anyway, now Biggie, this thing's impressive. It's a 95 on stability. I mean, and you get a 10, and you're getting a 10.3% yield. That's not bad. Now SOXY's not too stable. It's a 42, but I mean, based on semiconductor stocks, I mean, what are you going to do? EGQ is not too stable either. The thing I don't like about that, if I want something that's not too stable, I want like a 30% yield. This only pays a 5% yield. Usually, anyway, so the EGQ is probably not going to be the editor's choice. Let's just say that. Then we have iDevo, 87 on stability. That's, not bad. But then look at this, Devo. Low yield, but I mean, it's the most stable one out of all of these on the darn list. The second most stable one is SBAR. I mean, for God's sake, Devo is 40% more stable than the SPY. I mean, that's pretty impressive. I may have to take a look at Devo for the editor's choice, but the problem is that to me, Devo doesn't pay enough yield. I'm a little bit of a yield chaser. I want as high of a yield as I can, but I just want as high of a yield at a reasonable cost to NAV. You can have a 200% yield, but it's going to be the cost of the NAV, for my opinion, is way too much. Or you can get something that's super stable with a 5% yield. You could get SCHD with a 3%, whatever. I think you can undershoot or overshoot both ways. And I'm looking for the perfect mix. All right. So do you guys have any favorites so far? Who are you pulling for? Hey, Fakeologist, I appreciate you being here. All right. I'm not knocking MST. I'm not knocking MST. But it is a good example for crazy price action. Like I say, you have MST in MicroStrategy's doubles. And if it's bottomed out and it doubles or triples in price, MST will be the best looking one on here. I mean, it's still super unstable. It's always going to have a high instability, but in a bull market, in the direction of the trend, you don't want stability in the direction of the trend. Like I say, the stable DEX is not a qualitative factor. It doesn't measure quality. It's a quantitative factor. But anyway, yeah, I hear you on that. At this point, I know it. At this point, you just, I don't know what you do at this point. I mean, anyway, but yeah, I'm sorry about that. That sucks. It sucks, but never bet against Michael Saylor. If he can bring that, one of two things is going to happen. That fund's either going to get delisted. MST is going to get delisted. Or if Michael Saylor brings back strategy, and a lot of that will depend on the price of Bitcoin going up. But if Bitcoin will go up, like everyone says it's going to, and get to 125 by the end of the year, MST's price will recover quite a bit. Now, I don't know if it'll ever, recover enough, but whatever, it'll look a lot better than it does now. So anyway, all right. Well, all right. So I'm trying to think I'm biased. I just think, not even thinking about the metrics, just from living in real life, I think GPTY is the best. Is my favorite of these. If you stuck a gun to my head and made me get one of these, and I had a lot of it, but unfortunately I sold it. But I sold it when the market was high. I was afraid in late October the market might do exactly what it did. So I sold all my GPTY. I guess I could buy it back cheaper, but I'm just saying, if that's my bias. I think that one's good. I think Big Y is good, but there's other ones on there that are good. YMAG's pretty good too. SEPI's really good, and FEPI's really good. So those are my biases. Okay, so we're going to dispense with the biases and let's get on with this. Let's see what the max factor says. Now the max factor is now called sustainability. It's the same thing. I just need to retitle this the max factor. I made this sustainability metric, and it's even a better metric than the old max factor was. But so the sustainability is the new max factor. The other thing is it ranks everything the same. Sustainability is a better way of communicating what I'm trying to communicate. Anyway, let's see what we have. Let's let it rip. Oh, what do we have here? Number one is Soxy from our friends over at YieldMax. Now look at this thing. You have NAV that's gone from 53 to 58. That's, it's up 9% and it paying a 9% yield. Come on. That's a good looking fund. One of the ones I mentioned that I liked, I didn't mention Soxy, but I really think Biggie's, highly slept on. People are always griping that YieldMax needs to fix the erosion, and they fixed the erosion. Biggie doesn't have it. But no one bought Biggie. It has like 20 million under management, whatever. I hope if they would take Biggie to a weekly fund and they would boost its target from 12 to 25, then I think that people would stop sleeping on it so much. But whatever, it's not for everybody. I get that. Look at this, iDevo. I know that's going to make a lot of people. I always hear so many compliments on iDevo and Devo. A lot of people love those, just like a lot of people love CLM and CRF. I almost put CLM and CRF in this one, but I decided to save it for tomorrow night because they're closed-end funds. So we'll have those tomorrow night. But those are really good ones also. But yeah, iDevo and Devo, I mean, yeah, they pay a low yield, but they protect your NAV really well. They aren't very volatile. They're safe as can be, especially Devo. I mean, you could definitely do worse. Anyway, EggQ. Now, this is one that's not going to get the editor's choice. But I mean, I don't know. But it is positive on NAV. I mean, if you're first, my good friend from Discord, Mark, said this once, and I've adopted it. But yeah, a trader's first job is to protect your NAV. Well, anyway, Soxy, Biggie, iDevo, Devo are doing a great job protecting the NAV. If that's your first job, I mean, these have been doing a great job, and it's hard to argue with those. Okay, but for editor's choice, though, for editor's choice, I'm just looking at these myself. I mean, I'd like to make a little bit more yield, but I don't want to sacrifice too much NAV. But but I mean, it's just so tempting. GPTY paying 35, and it only was down 2% this quarter. I mean, I think that's more my style. SpyT is a little bit too low paying. But FEPI is actually ranked a little bit higher. Then we have SBAR. I mean, SBAR is impressive. Editor's choice goes tonight to FEPI. Does FEPI beat out GP? Even though I prefer GPTY, I mean, if you're looking for a good compromise, FEPI's pretty hard to beat. FEPI's hard to beat. I really like that one. All right. Well, anyway, did you guys like that? For the win is FTW. Anyway, heck yeah, Kay. Yeah, I mean, GPTY is, you guys have seen my videos on it. It's had a really good quarter. The downside about GPTY is because you can compare it, and I've shown you guys this a million times. You can compare it to anything that people love, TDAC, T-SPY, SPY-I, Triple QI, doesn't matter what it is. GPTY is spanking all of them. But on a lot of those, it also it's definitely more risky. And in the April pullback, GPTY was down more than any of those. So it's not for everybody. They are doing really well, but they also take a little bit more risk. But anyway, yeah, but it is a pretty impressive fund. But if you don't like the kind of risk GPTY is taking, FEPI has the similar exposure to the market, a little bit less yield, a little bit better NAV return. And people sleep on YMAG a lot also. It's just on Twitter. I mean, and I've shown you guys this before also. Let me drag this window over here. Now YMAG didn't do very well in my contest, but but I was just on Twitter, and people were talking about how much they like Maggie. And yeah, I like Maggie too. I mean, Maggie's all right. I mean, but I mean, the problem with Maggie is it pays too low of a yield to be behind this much on YMAG. I mean, like I say, I can always see both sides of any equation. So the other side to that equation, did you guys see that? I don't know if that was displayed. Hang on here. Yeah, I guess you saw that. The other side to the equation is, let's look at the metric. Let's follow the data, trust the science, so to speak, whatever. Maggie is slightly safer, slightly less volatile than YMAG. So, I mean, that's the, I do see a use case for it. I mean, it pays 33%. That's good. And it had an 83 on stability. I mean, that's really good. I just, with my money, I just prefer, where's YMAG? With my money, I would rather earn 53%. I mean, sure, the NAV was down 5.7 instead of 4.7. I'd rather trade 5.7 for 50 than 4.7 for 33. That's just me. You do you. But the other side is, YMAG is only a 63 on stability, where Maggie's an 83, and they both have the same stocks. It's a real good apples to apples comparison. Round Hill's a great company. Round Hill does a great job. I have a lot of their funds myself, or I have what I have. I wouldn't mind getting more, but I have WPay and I love it. You couldn't pry WPay from my cold dead hands. I love WPay, so I'm not saying that bad about Round Hill, but it's kind of a bad look for Maggie. In my opinion, to be getting spanked that bad by YieldMax right there. To be honest, most Round Hill products, usually when you line them up against the competition, they usually beat, but not Maggie for some reason. But like I say, it is pretty safe. It is pretty safe. All right. So, yes, GX switched to lightning spreads, and they switched to the block methodology. They aren't all lightning spreads. They're going to have about a third of the portfolio is going to be directly in commodities. They have one that's gold, one that's they have gold and silver. Or is that right? Or they have one that's nukes, one that's weapons, one that's anyway. On the gold, I forget if it's gold and silver together or just gold. But anyway, but on that one, they're going to have direct, just like Blocks has direct ownership of Bitcoin through the ETFs, HODL, ETHA, and FBTC, with about a third of the portfolio. They're going to do the same thing from what I understand from reading the prospectus, they're going to do the same thing in there. So the one that's gold or gold and silver, I forget which one it is, but whatever, is going to have stocks like GDXY or GDX and GLD in a third of their portfolio. And they aren't doing lightning spreads on those. They're going to do covered call spreads. Okay, but then on the other 2/3 of the portfolio, they're going to invest in stocks like, gold mine, Barrick Mining, and I don't know, whatever the gold stocks are. Anyway, and they're going to do lightning spreads on 2/3 of the portfolio. So it's going to be a good mix. They're going to sell calls on some things, sell puts on some things. I mean, I've really enjoyed Blocks. I think Blocks is incredible. They're going to kind of turn GX into Blocks from what I can tell. But Blocks is based on crypto. GX is based on global indexes and, emerging markets and that kind of stuff. So anyway, make sure if you like GX, make sure you're bullish on the stocks that it holds. It holds some emerging market stuff. I mean, it's going to do better if the emerging markets in Europe and China do better. But it also has some American exposure because these American companies, lots of them are global companies also. All right, Brad, what are you saying here? You have FEPI shares from when the fund was released, small allocation, and stopped adding to it early on, maybe worth looking at it again. Well, I mean, yeah, FEPI, so here's the thing about FEPI, and here's what Rex does different than YieldMax. YieldMax was the first people to do weekly options. And that's why, that's the reason people love YieldMax, but it's also the reason people hate YieldMax. But the weekly options, what a weekly option does for you is it caps your upside more effectively than a monthly option. FEPI uses monthly options. So the YieldMax, and you can tell FEPI you compare FEPI to, let's see here. Where is it? Okay, FEPI pays 25 using monthly options, which is really good. But, something like GPTY, which uses pretty much the same stocks, the same type of stocks, pays 35%. Okay, but because FEPI pays a little bit less and because it uses monthly options, it gets a little bit more NAV upside. So, yeah, it's FEPI's always been a great compromise, but a lot of the stock people, a lot of people, basically the stocks that everyone thinks are so stable or whatever, they're all monthly stocks, almost all of them. Not T-SPY. T-SPY is an exception, but all the other ones that are like the bastions of stability, the blue chip ones that, those are all monthlies. And it just, it's just the way it is. The weeklies don't give as much NAV stability, but they give more yield. It's a give up type situation. But yeah, YMAG has done it. YMAG's impressive because I'm not trying to bag on Maggie. When I read the prospectus for Maggie, I was like, I like this. I'm going to get this. And I never did. But I mean, I love the prospectus. I like Round Hill. I like what they're doing. But in hindsight, looking backwards, it would have been a lot better to buy YMAG. And I've never had YMAG either. but I had YMAX for a while, and I have the stocks in YMAG through other stuff. I had GPTY. All the stocks that are in GPTY, I think, or all the stocks that are in YMAG, I think, or a lot of them are in GPTY too. So anyway, yeah, but YMAG has done pretty well. Hey, Marcus, what's up? What's up? How are things going in Philadelphia? I bet it's cold up there. Man, it was beautiful in Austin today. It was, I mean, not a stitch of wind out. I mean, it was clear and cool. It was like 60, 65 or something. But I mean, Jackson and I went on a walk after dinner about sundown, or a little bit, about an hour before dusk, about 4:30, 5 o'clock. And man, it was so nice. All the families were out taking pictures in front of their house. Some people had set up tables in the backyard, and we're doing Thanksgiving. It's a great day here in Austin. Great day here in Austin. All right. So what else do I have to show you guys? You guys can ask questions if you want, but I think I have maybe some other stuff to show you. We'll see what we have. Let's just check the market. I mean, the market still looks strong. The market still looks strong. I mean, this is a daily chart of the Qs. I mean, you got to love that they've taken back the descending trend line. That's incredible. To be fair, I don't have it drawn on this one, but they've lost the ascending trend line. But anyway, they've probably just about taken that back too, as well, or they're getting close. So we'll see. Rome wasn't built in today. Okay, so what did I have to show you guys? Yes, I thought you guys might like this. I didn't use this in the video, but what I did is I took Altis trades from yesterday, and then I took Altis trades from a month ago, and I put them, and I did a correlation analysis. Do you guys remember the other night we got in Portfolio Visualizer and we were looking at how much things were correlated to other things or whatever? So I was under the assumption, I didn't talk about this in the video, but I was under the assumption that the way they were trying to make the ETF safer was by reducing correlation, but no, they've actually increased correlation. The ETFs that they were doing a month ago was totally uncorrelated. They had 30 different stocks that were totally uncorrelated and super volatile. But because of that, sometimes you want a little correlation, because when you have a little correlation, sometimes you want a little correlation. Anyway, so they've actually made the new portfolio is more correlated, but it's less volatile also. The old portfolio, they just chose stocks that were more volatile and less correlated. Anyway, so let me see what I have here. I thought maybe you guys might like this. So this is the current build. This is the current build. They don't have SPY, but I put SPY in here to compare it. And then these are, so they do have Qs. And so they have Qs, and they also have Lam Research. Well, that's a 76% correlation. But so these are the highly correlated stocks that they have in there. They Qs and Broadcom are highly correlated. Whatever. They have some highly correlated stuff. That'll be good for when the market finally goes up. If the market rallies, that'll be good. Their old build was so uncorrelated that it really didn't take advantage of the market going up as much as it could have, believe it or not. Now, the one thing is, though, when Bitcoin went way up this summer, it did well then, because a lot of their stuff was Bitcoin related. They de-Bitcoinified. But anyway, but then they also have some low correlation in here too. So they have Broadcom compared to bonds. Well, that's not correlated at all. Bonds to Facebook, not correlated. Gold to American Express, not correlated. Bonds to Lam Research, not correlated. Southern Copper to bonds, not correlated. You guys get the idea. Teradyne to bonds, not correlated. Alcoa to bonds, not correlated. Quanta Services, not correlated with bonds. Bonds to Morgan Stanley, not correlated. And bonds to American Express, also not correlated. So, but then we can look, like I said, they don't really have the SPY. I just made it part of the table because I wanted to compare it. I wanted it to be my benchmark, but anyway, so I don't have the SPY in here, but but this is the average correlation. So like Lam Research and Teradyne, Google, Broadcom, if the market would ever, make all-time highs, these should be rocking and they should be able to take advantage of that. Morgan Stanley, Facebook, all that kind of stuff. But in a defensive situation, like Eli Lilly's a growth stock. No one would doubt it's a growth stock, but it's like 98% uncorrelated with the market, meaning it doesn't matter which way the market goes. Eli Lilly doesn't react to the market direction. The market direction doesn't, determine much of Eli Lilly. See, this is the kind of video I usually make. I would usually just go through here, and instead of writing a script and making slides like I did in the other one, I would just like to do this. So anyway, I'm doing this now. But anyway, so you guys can see that. So this is pretty cool, a risk versus return analysis. So this measures all the stocks on the, on how much they've returned, I think the past 3 years or the past 5 years, November 20th through 25. So look at SoFi, an average return of 22%, but it's all the way down here. Volatility is all the way down here. These are the more volatile ones, above 50 on a volatility is crazy. Twilio's actually had negative, return and high volatility, but, hopefully that'll turn around. But Alcoa's done pretty well, but it's been super volatile. But remember, they have Alcoa in there. It's a precious metal. It's aluminum, not precious metal. But they have that in there for diversification's sake and for safety. But then you have TMF. Bonds have done terrible the past 5 years because rates have gone up. Bonds do well when rates go down. Bonds do poorly when rates go up. Now rates are turning around. So, hopefully they bought the dip in the bonds and hopefully they know what they're doing on Twilio. But then kind of their average stocks, these are, like look at this one right here. Broadcom has a 62% return over the past 5 years. That's per year. That's average per year. Yeah, CAGR. I mean, that's incredible. I mean, it's, anyway, and it's not too volatile. It's only a 38 on volatility. They have Lilly. Lilly's a monster. I mean, it's averaged 50% a year for the past 5 years, and it's only a 33 on volatility. That's not too bad. Anyway, you guys get the idea. I kind of like this better than my video. I kind of wonder if I should have just done the video like this. But anyway, this correlation matrix is pretty cool to look at. The ones that are bright yellow or gray are the ones that aren't correlated. So you can see lots of their portfolio is not very correlated to each other. So anyway, that's good. But in any event, if you guys have any questions about that video, I'd be happy to answer it. Bond was watching that video, but then put it on hold. You don't have to finish it now because you just seen the whole. Now, I talk about a little different stuff in the video. All right. What are you doing, Marcus? You're visiting your family in Virginia. So much more trees and so much more space. Heck yeah. I mean, yeah. Man, I love me a good city, though. I don't care. I do like the suburbs also. I like city and suburbs, but the country doesn't do anything for me. I know it does for a lot of people. And I really like suburbs. I like suburbs that are close to the city. That's just kind of my jam, but I like cities. I think cities are fun, even though there's crime and homeless and stuff. I just think a city just has a different energy and cities are cool. I've never been to Philly, but I'm going to come to Philly and we're going to go get a Philly cheesesteak sometime, Marcus. All right. LLII is new, but what do you think about it? Yeah. I really haven't studied it that much. Okay, but I'll study it right now. Let's go look at it really quick. I mean, I know it's Eli Lilly, but I'm not. But other than that, and it's Rex. Okay. Well, I like it already if it's Rex. All right, so that also tells me, so Rex does a strategy. Rex does half yield max strategy. The yield max strategy is synthetic covered calls. Okay, but they only do that on half the portfolio. The other half of the portfolio, they do the round hill strategy, which is using a little bit of leverage and not being capped, because round hill uses total return swaps. But so they have half the portfolio is, it's a great mix. I mean, it's a great mix, but of course, I mean, the number one thing is what's the underlying. If it doesn't matter what you pick, if you have an underlying that's on fire. I mean, it matters, but but the number one thing is choose an ETF with the underlying that's going to go up in your business. But and then the number two thing is, and if you don't want a bunch of erosion, choose an ETF that has a lower yield. And if you don't care as much and you're fine with a little erosion, choose an ETF with a higher yield. So let's look what this thing's going to pay. So look at this thing. They've only paid 2 dividends yet. They paid 2.28%. It's not old enough to be on the max factor, but it's been out a month. We'll call that a month. So let's multiply 2.2 times 12. So what does that equal? 24 and then 26 and a half or something. I mean, yeah, you could do worse for sure. Looks like it's going to pay 25, 26%. I like it. Thanks for bringing that up. Well, hey, Chad, how are you doing down there? How are you doing out there in the suburbs of Houston or the exurbs of Houston? Where are you? Aren't you like Tomball or something? You're out there east. Anyway, I get confused, but anyway, you're out there I picture you as being in the exurbs of Houston, but maybe I'm wrong. Maybe you're in the suburbs. Easy is in the house. Heck yes. Otherwise known as Chad. Anyway, Chad, you missed a good live stream. I'm trying to think who won. It was Max Factor, Dealer's Choice, and I chose FEPI as the winner. But something else actually won, but I chose FEPI. Let's just run it down really quick. Since Chad just got here. No. Where is it? Oh, okay. Yeah. Soxy and Biggie. Soxy, Biggie, iDevo, and Devo won. And I mean, Biggie could have been the Dealer's Choice also, but I just like a little higher yield than that. So I went down here. I think once you consider the yield and just using my own judgment, to me, this one it was between this one and GPTY, but I chose FEPI because it was ranked higher and it protected NAV better. I mean, FEPI's a good one. East Beltway, a humble area. Okay. I got you now. All my friends here in Austin are from the west suburbs. My two best friends from Austin are from Cypress and Katy. And about half the world's from Cypress and Katy. Those are just giant freaking suburbs. But yeah. Heck yes. All right. So let me show you what else I have for you. I'd be happy to answer any questions or whatever you guys want to talk about. Hey, just real quick, in case you guys didn't see my video, I like talking about this stuff. This is Alti's old strategy. They sold an out of the money call and they bought an out of the money put. They have cap downside. They get a credit. They can only lose about 20% on Teradyne, whatever. Easy peasy. Here's their new strategy. And this is an actual trade they have on. I didn't put the right share numbers in there, but this is the strike and everything I got this off their trade report. Well, then this is a different stock. I always forget what ADI is. It's something easy, and it's advanced digital. It's not advanced digital, applied digital. It's something so easy, and I always have to look it up. In fact, during the show tonight, I saw ADI and I drew a blank on what it was, and so I just skipped it. It's something applied digital, it's something super analog devices. I've always felt so stupid. Anyway, all right. Well, so this is the trade they have on in analog devices right now. It's the same strategy. They just add an extra put. So the reason they do that is because they put more blue chips in their portfolio. Well, blue chips don't have as high of a yield. So instead of just selling a call, they're selling a call and a put, otherwise known as a covered strangle. There's people out there that it's in books and everything. It's an old fashioned strategy. Buy the stock, sell a call and a put. And that's a covered strangle. But they're doing a covered strangle and they're collarizing it by also buying it out of the money put. But this other put helps cut the put drag. Anyway, so these are the two strategies that ULTY is using right now. They're using the 3-leg collar like this, and they're using the 2-leg collar like that. That was in the video today. Let's see what else I have for you, if anything. Here's my slides from the video today. Here's my slides. You guys probably saw the video. I'll show you the best slide. This is the best slide. This is the 8 pillars of what they're doing right now. So they have mega cap tech, Google, Facebook. I've already forgot what ADI is, analog devices. All right. Then they have broad market exposure with the Hughes. Then they have defensive stocks with Lilly. And then they have big financial, old Wall Street, American Express, Morgan Stanley. I mean, but then they have infrastructure plays like Quanta Services, but that's a good one. Then they add in some defensive hedges. That would be gold and bonds. Then they add in some proven growth. I don't know if I call Twilio proven growth, but anyway, it's a growth. It's hopefully going to grow. But SoFi and Teradyne definitely count as proven growth. Then you mix in with that a little commodities to get a little, exposure to, aluminum and copper and stuff like that. They aren't really precious metals, but they're industrial metals. That's a big deal. So anyway, FEPI versus GPTY, has that been done? Oh, that is just that one's going to be an individual. I talked about it. The reason GPTY is more stable, other things being equal, is because it pays a lower yield. But why does it pay a lower yield? It pays a lower yield because they they use the same stocks, basically, same types of stocks anyway. They have a lot in common. Monthly options are less efficient at capping upside, but also less efficient at gathering yield. FEP uses monthly, GPTY uses weekly. If you're really ultra concerned about NAV erosion, FEPI is probably better for you. If you don't care as much about NAV erosion and you don't mind a little bit, GPTY might be better. But let's just run it real quick. Let's run it right here. I don't know where my dividend channel went. Let me just open it again. Maybe I messed it up. But yeah, FEPI versus GPTY. We did run Maggie versus YMAG, and because I know I've shown you guys that one a million times, but that's a bad look for Maggie and a good look for YMAG. All right, FEPI versus GPTY. It'll be hard to beat GPTY, but we'll see. GPTY, they both lost NAV. To be fair, 50 to 45, it's just $5 though over 2 years. That's nothing. This is $6 over 2 years. That's, to me, that's nothing. That's, especially when you can lose $6 when you pay $12.80, or you can lose $5 when you pay $10.63. But yeah, GPTY, is 13.4% total return to FEPI's 9%. They're both good. It just depends on what you're looking for. GPTY is just, GPTY is incredible. Anything that could spank SPY-I and T-SPY and that kind of stuff. It just, and those are the ones everyone thinks are just super stable. And they're good funds. But to be fair, and we talked about this earlier, to be fair, GPTY was down a lot further in the pullback. So SPY-I would be better for a lot of folks, to be sure. Especially if you only need 12, 13%. A GPTI pays like 35. GPTY pays 35%. But, it just depends on your needs. It just depends on your needs. For each his own, right? Yeah, GPTY is incredible. GPTY is absolutely incredible. But there's a lot of good stocks out there. We really just need this market to come back. That's the only reason these started doing so bad, especially the ones I'm in are all crypto related. Because I have WPay, it's been getting murdered. I have K-Yield. K-Yield's not really crypto related, but it has tech stocks. I have Blocks. Blocks is crypto related. It's just been getting murdered. ULTY it used to be crypto related. They decryptoified after the market dropped. Here's my prediction. My hot take on Alti. Retail gets all mad about everything. And so they go and change the fund. Okay, great. But here's what's going to happen. We're going to go to 125 on Bitcoin, 130 or whatever. The rally is going to happen. I don't know what it is, but just, that happens, and everyone's going to, and Alti's going to underperform because they decryptofied, and everyone went crazy because of the erosion and stuff. You can't, there's no escaping it. I mean, it's a, they have to invest in something. Before they had a lot of Bitcoin, and they did really well when Bitcoin was running up. Then Bitcoin goes down, everyone panics and sells it. And then they panic and de-Bitcoinify. So that would just be poetic justice. If Bitcoin goes to a new all-time high, Alti will do all right. I mean, it's, but I'm saying it's not going to do as well as if they would have just left the old one in place. Look at the old one was amazing. I mean, check this out. This is what people miss. Yeah. And this is not dividends included. I'm not showing dividends included. And let's put it on daily. Let's put it on daily. And now let's see what happened here. And let's do SPY. Okay, but instead of the SPY, let's do HODL, because they were pretty much 100% correlated to Bitcoin before. It wasn't 100%, but they were like 70% correlated, more correlated than they even were to the NASDAQ. So look, so Bitcoin went from, or HODL, I know it's not the same, close enough, went from 22 to, well, we'll go to the same time. They made, their high was right here. So 22 to 33. Think about that. That's a 50% face ripper. That's a lot. I mean, and that's the stocks they had in their portfolio were those kinds of stocks. They even had wilder ones than HODL, but anyway, whatever. 50% face ripper. So yeah, you get a 50% face ripper in 3 months. That's about 200% a year at that rate. Now, of course, it's, that's incredible. That's not going to happen very often. But of course, Alti had upside. Of course they did, even without dividends considered. They didn't go up 50%, but it's because they were paying a dividend to you. They would have gone up 50% if they hadn't paid a dividend. But anyway, whatever. So, but even as it was, they went from 530 to 640. That's 90 cents on something that costs 530, 9, 18, 27, 36, 45, 1/5. It's about 18%. They had an 18% NAV, in a quarter. That's incredible. Because it wasn't just the NAV. Like I say, this doesn't include the dividend. It was going up and people were getting paid. So people were like, holy cow, this thing's free money. And it would have been. It would have continued. If this would have kept going up, so would have this. That's all there is to it. But anyway, you watch this go back to all-time highs, and you watch this go from, we'll just use the same thing again. If this goes from 25, so it goes up 50%. So that would be from 25 to what's 1250 plus 25 is 3750. So if this goes up to 3750, which would be about the same move that it made this summer on a percentage basis, which would be a new high. That would be a new high, and it very easily could do that. It goes to 3750. Well, we need to make this go up about 18 or 20%. I'm going to do 20 just to make the math easier. So this is, call it 4. So 20, so 40 cents is 1. This will go up 80 cents. Well, it would have before they changed the build. It may not anymore, but this would have gone up 80 cents. So this would go from 4 to 580, so, anyway. But the thing is, it would do that at the same time you're getting a yield. So the people would have NAV upside, and they would have you watch. If it does it again, and it won't because they decryptofied, but if it does it again, people will start piling in again. I'm afraid. But that's my hot take. I bet in trying to fix it, I bet they really messed it up. Not that it won't do well. If the market goes up, it'll do a lot better. I mean, everything will. But I mean, that's my hot take on it. All right. So what else is going on? You're saying 90K. Well, it's traded. Bitcoin's trading at what's Bitcoin trading at right now? It's trading at 91, isn't it? Let's look at Bitcoin on Coinbase. 91,021. Heck yeah. But I mean, it still has a lot of damage to do. This could easily be a sell the rip. You know what I'm saying? It could fail here and it can make a new low. A lot of people think it needs 70 to 75. I mean, but whatever. And if it does that, then they're going to look really smart for doing the new build. But no one will give them credit. But then they would have. Then it's the right thing to do, especially if it keeps going down, because they did decryptoify. But if crypto goes back up, people are going to be cussing them because they won't go up like they did this summer, because they de-risked a little bit. Anyway, whatever. All right. Yeah, it's at 91 right now. Block should have a nice pop in the morning. Heck yes, you wore your hat all day. I have mine right over there. I don't know if you guys can see it. It's that white thing right over there in the corner. Yeah. Heck yeah. Did your family ask you what the heck Blocks is or something? Anyone get in any political disagreements with their family? There's always, whenever you get families together, there's always the super liberal member of the family, but then there's always a super conservative, and lots of times people butt heads on Thanksgiving. But at my Thanksgiving party, we're all along the same lines. We did talk a little bit of politics. We were talking about how much we want Tom Massey, or somebody that's actually really means what they say, in 2028. Now, I don't know if we'll get him, but somebody that has a lot of principle and stuff. I would love somebody like Tom Massey. Anyway, but that's about as far as we got into politics, and we all agreed on that. We all could agree on that. So anyway, yeah, they would catch a lot of shizzle for that, wouldn't they? They would catch a lot of shizzle for that. All right, guys. Well, I'm going to get out of here. It's Thanksgiving. Go spend time with your family. I'm going to go work. I'm going to finish up that GX video. I've got to get that GX video out, and I'll show you what I have coming out. This is the last thing we'll do here. Let's look at what I have planned for you guys. Let me drag this window over here. Okay, so I'm getting behind. I need to do a review on this thing. What is this? This one's crazy. This is a smart allocation high income ETF from Tidal. I'm not sure what to think about that one yet, but be watching for that. Okay, Rex. This is really interesting. I don't know if this is their version of ULTY or something. It's kind of a generic thing, but it's called the Rex Income Max Option Strategy. I think it may be their fund of funds where they throw all their products in, like TS2, MS2, and I would definitely be interested in that. The prospectus doesn't really tell you that much, but that's coming soon. And what's this one? This one is, what is this one? Oh, this one's the most complex one. This one is the Tuttle Capital No Bleed Tail Risk. This one's going to be interesting. I'll probably be more interested in this one than you guys will, but I'm going to get an option strat and kind of show how some of these or not options. Well, yeah, I'll get an option strat, show how some of these strategies might work, and then I might back test them. That one's going to kind of be technical. But I think the ones you guys are mostly waiting for is GX. I think GX will be a good one. And then what is this one? Roundhill? Oh, yes. Okay. This one's Vibe, and it hasn't come out yet, but I'm very excited about that. This is going to be Roundhill's Alti competitor. Alti Blocks, Alt-I, whatever you want to look at it, K-Yield. It's going to be one of those ones that is going to be fun. So I'm making a video on that. What else do we have that's coming up? That's the No Bleed Tail Risk. Curve. This one is... Oh, this one is I'm not that interested in this one, tell you the truth. It's LQID. It's a super safe. It's like a bond fund or whatever. You know me and bond funds. It's whatever. It could definitely work. But I need to do. I'm probably not going to do the content on that. So anyway, the main thing I'm working on, the two main ones that I'm focusing on right now is the Tuttle No Bleed Tail Risk and the GX. I'll get those out soon, hopefully tomorrow. All right. How was the party crash? You flipping tables? I guess I'm behind on that conversation. No, Bond's always polite there, of course. You thought Alt-I was already with Rex. Let me think about that. You're right. Rex already has an Alti competitor. You're right. So what is that other fund then? I mean, I think it's going to be. I'm telling you, the prospectus is so generic; it gives away no hints. No hints. I think it may be their fund of funds is what it is, and that would be good because it would be more like a WPay competitor. But you're right. Alt Y already has a competitor from Rex named Alt I for sure. Yeah, that's a good point. That's a good point. Well, guys, if there's nothing else, oh no, Froggy just showed up too late. You're too late, Froggy. I'm tired. I'm going to get out of here. I got to go make videos. You missed it. Go watch the replay. I think we had a good meeting tonight. Oh yeah, Penelope, I hadn't seen you in here. Will I be buying Alt I from Rex? Well, I would have if I would have had a pair. I chickened out, and I'm glad I did because I was going to buy it 2 or 3 weeks ago. When the market started dropping, I chickened out. But I should have. But then in the back of my head, a few days ago, I was thinking maybe I do need to get some of this because wonder if the market recovers. And I chickened out, and now the market's up so far, and I feel like I missed the buy. Anyway. Yes, I will at some point, but right now, to be honest, I still don't think this market's out of the woods totally. So maybe I'll get a chance at ULTI later. But I am needing to put some money to work. I have about 20% of my model portfolio in cash right now. And I don't want this market to go back to all-time highs and me not be on board. But really the first thing on my list right now is QLDY. And maybe some more WPay. But those are the two that because I only have like 5% WPay. I'd like to make WPay go to 10 or 12%. And I only have like 6% QLDY. I'd like to boost. Maybe I'll get some of both. But those are the ones that are on my immediate list. But Alt I is on my list, especially if we get a deeper pullback or something. But I missed my chance on that. I chickened out and I missed my chance. Yeah, I do love to second guess my trades. I think too much about stuff. I'm over analytical. I think too much about stuff. You gotta hit the buy button. I know it. You just gotta close your eyes and hit the buy button. I mean, to be honest, I was going to buy Alt I the first day it came out, and it wouldn't have bankrupted me or anything. I'd been fine, but man, my portfolio was a lot better off for the sake that I didn't get it the first day it came out. And the only reason I didn't get it's not because I'm smart. It's because Tasty Trade had it on close only. And then by the time they fixed the problem, the market was getting crushed. And I was like, no, I'm going to hold off. Hey, Udar, how are you doing, bud? And Jameson's here also. SLV is showing a monster teacup. Are you upping your K-Silv? Well, wasn't planning on it. We can go look at that real quick. I was just getting ready to get out of here, but we can go look at that. Let's see what we got here. Let's see what we got. Where is that? Teacup pattern, huh? I mean, I have 5% or 6% K-Silv and 6%. Between K-Silv and K-Gold, I have like 9%, 10% or something. I mean, I think 10% is enough on the precious metals for me for right now. So wasn't planning on it, but yeah, cup and handle right there's the cup, and then there's a handle. I mean, we put them on a shorter time frame and get a better resolution on that. Something like this. Is that what you're looking at? Anyway, maybe that's too short of a resolution, but anyway, yeah. Or no, wait, yeah. Oh, you aren't talking, that's never mind. I'm an idiot. You're talking silver, not T-Silv, whatever that. Oh, absolutely. Oh yeah, absolutely. That is a massive teacup. Oh my gosh. Yeah. I should have bought the retracement to the trend, to the moving average. But really the reason I didn't is because I think I'm allocated all right on gold and silver right now. I mean, like I say, QLDY from Defiance is one of the best funds out there. I think it's very new, but from the looks of it, it does lightning spreads, and lightning spreads are the wave of the future. GAX is switching to lightning spreads. YieldMax has a whole, or is it YieldMax or is it Defiance? I forget. It's either YieldMax or Defiance, but they're coming out with a whole suite of lightning spread products. Individual stocks, they're going to have an Apple lightning spread product. They're going to have they're having a whole suite of those coming out. So the lightning spread, you're going to see the 2026 is going to be the year of the lightning spread. Block started it off. Then QLDY was the second one to have it. But also Tuttle from Tuttle Capital is coming out with a whole suite of lightning spreads. Lightning spreads are really badass. Yeah, no, I know it, Froggy. I know it. Somebody was on the stream last night. I don't know who it was. They bought 81 in Bitcoin. And I said, how the heck did you do that? And he said Fibonacci retracements. And I'll be damned, I put a Fibonacci retracement on here last night, and it was to the penny, the 61.8 pullback. I mean, it was to the penny. And yeah, let me show it to you guys. Yeah, there's the 61.8 on the Fibonacci. I mean, it depends on where you run it from and to. Let me let it go on a longer time frame. But if you're going from the last bear market pullback to 50, and then you go to the high at 130, I mean, the Fibonacci number just hit it to the penny. To the penny. Now, sometimes that can be a self-fulfilling prophecy. Maybe other people were seeing that too. And I don't know if it's really that Fibonacci's work or is it that everyone looks at that number and it's kind of a self-fulfilling prophecy, or is it a little bit of both, whatever. But I mean, I forget who it was. It was, I don't think he's in here tonight. But yeah, that's the 61.8 there. But yeah, you run it from down here, this pullback at 50 up there to 130, and I'll be darned if it didn't. That was because a lot of people are looking for this area. I don't usually look at Fibonacci's. Maybe I need to start. I look at more supply and demand on the chart, and I don't know, different stuff. But man, that makes a good case for the Fibonacci pullback right there. That makes a great case. Yeah, no, I hear you. I mean, I think they're all important. I mean, to me, I try to be holistic. I think fundamentals are important too. I mean, earnings and stuff. And I mean, that's part of it. I think management's important. Some companies are managed better, but then when it comes to getting in and out of trades and timing stuff, patterns are one thing. I mean, double bottoms are great things to buy. You know what I'm saying? That patterns can be great. Cup and handle, that's part of it too. But I think you want to find a company with good management, good earnings, and that has and maybe that has a good looking pattern, and kind of look at them holistically. And then I like supply and demand and just kind of price action and whatever this is, market profile and volume profile. I think price and volume, in other words, price and volume, I think tells you a lot. But anyway, you pay more attention to price. Yeah, Penelope, I hear you on that. All right, Mitch Ray is a good technical analysis Bitcoin guy. Cool, I'll check him out. On harmonics, I had a friend that got into harmonics. One of the guys that was at dinner with me tonight, the one we were talking politics about. He's an option trader, and he has a job, but he does some trading on the side. And he got into Elliott Wave and harmonics and got really good at it. I never really did understand Elliott Wave, but he did. He figured it out. Yeah, on KSIL, not for me. I mean, I have enough of it. If I'm buying anything tomorrow, it's going to be QLDY. All right. So Richard, just watched the video on Altine. You're very impressed. Okay. Well, yeah, like I said, I kind of had a hard time. I'm not good at reading the script. I need to get better at presenting the script but I'm used to just being able to talk better. But anyway, I think it was a good video, and I think the slides and the artwork was really good. But yeah, thank you so much. All right. Bon, you've been buying a little QLDY, but it's Defiance, so you're worried. Yeah, absolutely. Absolutely. But you know that you can't judge a company because a lot of people hate yieldbacks, but Big E, GPTY, and it doesn't mean all their funds, are bad. But some of them are good, some of them are bad. Defiance, I mean, I'm with you. There's Defiance funds I wouldn't touch with a 10-foot pole. But I mean, QLDY is wonderful. So I mean, I take it on a case-by-case basis, is all I'm saying. I take it on a case-by-case basis. All right, guys. Well, thank you so much for being here. Okay, so I'm trying to get a new show going. So in the morning, I'm going to compare all the trades of ULTI, ULTY, blocks, and K-yield. And I'm going to talk about the big ULTY sold out of Symbotic, and then it popped the next day and it cost them all kinds of money. I'm going to talk about that kind of stuff. But be looking for that. That show will come out about 8 in the morning. The reason it doesn't come out to that next morning is because Rex at ULTI doesn't publish their trades till 6 o'clock in the morning. So I have to get up in the morning and prepare it a little bit, but then I'll put it out. Anyway, but that show has not been great. I haven't been happy with it, but I've made some improvements to it, and I think it's going to get better. So be watching for that show tomorrow. And then sometime tomorrow, my video on GAX will come out. I'm going to do GAX video tomorrow. Then I'm going to do the Tuttle the Tuttle Tail Risk Fund the next day, and then I have 2 or 3 videos planned coming out. But anyway, all right, Tuesday, Thursday payday has me scratching my heck yeah. All right, yeah, I never thought I would hate monthly so much. I like this everyday stuff. Yeah, I mean, well, that's one thing about QLDY, and I forget about that. Yeah, it pays. It says in the prospectus it's going to pay daily. They could switch it to daily pay and they wouldn't have to do a new prospectus. The prospectus is approved for daily pay, but they decided to make it twice a week. But yeah, that fund is, especially for somebody that wants to get paid more often. I mean, QLDY is tough. I mean, it's tough. I talk about it all the time. I know you guys have heard me talk about it before, but it's really tough to beat. But yeah, it almost seems like there's something wrong with monthlies now. I used to not be in favor of weeklies. I just thought it was just kind of overkill and stupid or whatever, but goes to show what I know. Nowadays, when I look at something, even though I don't care, I just think, oh, this fund's not going to make it because it's only monthly. It's like in the old days when you saw something that's quarterly, you're like, oh gosh, it's quarterly. Like Maxi was quarterly, had good performance and stuff. But I mean, who wants to get paid quarterly when you can get paid monthly? Well, weekly's the new monthly, and someday daily will be the new weekly, I guess. It's the way we're going. It's the way we're going. Did I misspell friend or something? Fiend, or anyway, I thought maybe I misspelled something. I'm perfectly, because you want that daily pay. Yeah, I got you. Fiending for more yeah, I got you. You're perfectly fine with weekly, but can't complain about twice a week. Yeah, nothing wrong with that. Yeah, no. So I keep talking about my friend I was talking to about Tom Massey, and we were talking about the same guy that does harmonics and Elliott Wave and stuff, and he's an option trader, and he has a job too, but he's not a full-time. He a long time ago when I first got into these, he asked me what was good, and at the time Triple QI was really good. I told him that my favorites were Triple QI and ULTY. This was a year and a half ago. And he bought both of them in his, in his IRA or his Roth, and he's just put them on drip and forgot about it. But he loves them. I mean, he loves them. He's going to start spending the money he may get a new car, and he's just going to start spending that income to make his car payment. But he loves them. So, now I guess also he doesn't watch my show. He has a job and stuff. There are better. I'm not saying there's not better ones out there now. But I mean, if you've had them for a year and a half and on drip, you're doing pretty well in those. So anyway, all right, guys. So I'm going to get out of here. Thank you so much for being here. And thank you for watching my video today. And I will talk to you guys in the morning. All right. I'll talk to you later.